Welcome back, Peter Boockvar, nominee for Fed chairman.
Hey, how are you?
Good, Peter. How's it going? So, I want to keep that theme going. You were nominated on Fast Money by Guy Adami to be, the Fed chair.
Yes.
So you're the Fed chair right now, Peter. So, what do you do? What would you do if you didn't have to worry about any, political ramifications, and you have the yields right here making new highs up towards 210?
I would start by, I would raise 50 on Wednesday.
Okay.
And 25 in May, 25 in June. So quickly get to 1%, and
Okay.
and then get a lay of the land, and then start talking about shrinking the balance sheet.
All right.
But the Fed is not going to do anything that much different. The question that would separate me from the Fed is that I've always believed that keeping inflation in check and having stable prices is the precursor for stronger economic growth and maximum employment. And the Fed, of course, turned that upside down in the 1970s, and Powell and company did the same exact thing over the past 2 years. So when you say, what would I do today? Well, it's what I would have done also over the past 2 years relative to what they did, which would lead up to today. If I was the Fed chair the last 2 years, monetary policy wouldn't be where it is right now. Then the question is you fast forward the tape, and let's just say the Fed gets the Fed funds rate to 1%, but all of a sudden the U.S. economy and the global economy starts to see GDP contraction, and the financial markets have softened further, but inflation is still very high. Does the Fed continue to raise interest rates? Now, we know that this Fed will focus probably more on the economy and financial conditions rather than where inflation is. Inflation will be a hope strategy for them rather than something that they'll tackle directly, and they'll blame the supply chains and they'll blame Putin and so on. Even though the Fed has been very aggressive over the last couple of years in trying to stimulate the demand side of the economy, particularly the interest rate sensitive parts of the economy like autos and housing, where there's just not enough of them to buy, and why we have record high car prices and we have home prices up 20% year over year and rents nearly up the same amount.
Yeah. So are they going to stop buying MBSs? They do want to cool the housing market now, right?
Yeah. I mean, that's done. They're no longer increasing the size of their balance sheet. The problem with their MBS portfolio is they're going to actually have to start outright selling them if they want to shrink that portion of their portfolio, because of the rise in long-term rates. You're going to see a shrinkage in prepayments. Therefore, the only way the Fed is going to see a roll-off in that part of the portfolio is to outright sell them, which a few Fed members have acknowledged that's what they're going to have to do.
Okay. All right. So what do you think the impact is going to be in the bond market? I mean, didn't 10-year yields do a lot of the work that the Fed's going to do? I mean, is it going to be, buy the rumors, sell the fact on yields after the Fed moves? You think that's a possibility?
The short end has done the work for them. The short end has priced in the 5 to 6 rate hikes. I think the long end now is very interesting in terms of its behavior, because it's been no flight to safety.
None.
The 10-year was 192 the day before that Putin invaded. Today we're at 207, 208. And I think there are two things. Obviously, inflation. I refer to the U.S. Treasury market now is sort of quicksand, in the sense that there's still a contingency of people that want to buy the long end because they see war, but it's quicksand because what you're stepping into is inflation that's eating up your holding. Now also, of course, and something that I've argued for a while is if you're going to try to figure out where the U.S. 10-year yield is going to go, you can't just look at where you think growth and inflation is in the U.S. A lot of the influence is going to be where the European bond market goes. Okay. And the European bond market putting aside Japan for a moment, was the epicenter of the greatest bond bubble, or the greatest bubble in the history of financial markets, with negative interest rates.
Right.
And as the air has come out of that bubble, now accelerated by the ECB, which has been mugged by the reality of inflation, and it now has to try to get out of negative interest rates, let alone QE, that the rise in rates in Europe is definitely having a spillover effect to US rates here. So now we're in an investing landscape where people are losing money in both bonds and stocks. And that's not something that people are used to.
Right. And the only thing that are performing are commodities, up until last week, huge run in gold, silver, and the miners. I know that you've been talking about this, always felt that they had long runways. So do we have takeoff here?
Well, I wrote a piece in October 2020 saying that commodities will outperform FANGs over the next couple of years,
Okay.
and particularly energy stocks. Now, that said, while I was pretty confident then, I'm much less confident now about where prices go. The fundamentals are certainly great, obviously exaggerated by the invasion, but a lot of the moves have been pretty sharp and extreme, and therefore I'm just uncertain about where we go from here, particularly on oil. It's easy to think that oil is going to go to $150 a barrel, which it easily could. I'm just less certain now. I think it's just more difficult. Now, that said, if it just stays here, these oil companies, and I'm long some of the oil stocks, and they're going to be printing money. I'm particularly bullish on the natural gas stocks, since natural gas is now probably the most, if not one of the most important commodities out there, particularly when you see what's going on with European natural gas prices. With respect to ag, I think the prices of the row crops like wheat, corn, and soybeans are going to remain very high and probably go higher. I'm just less certain, like on the fertilizer stocks that I've been long for the last couple of years. They've had a great run, and probably fundamentals are great. I'm just wanting to see what, if any, demand destruction we're going to see for fertilizers, as certainly in the Ukraine, unfortunately, there's going to be less acreage planted. And with farmers dealing with the spike in fertilizers, I'm wondering if they try to cut back. So I just think it's people just have to be a little more detail-oriented in their analysis here with the rise in commodities and the best way of playing it. I'm still bullish on nuclear and uranium, still bullish on precious metals, long-term bullish on copper, uncertain in the short term because of what's probably going to be a global recession in the coming quarters.
Yeah,
So
I thought that may
now.
have been what copper was signaling. It was the first commodity market to crack last week. And, when you look at it long term, though, it could pull back to 325 and still be in a big bull market, right?
I agree. I completely agree. But that gets to the uncertainty, is that prices still are vulnerable. So I guess the bottom line is, as certain as I was a few years ago, and up until pre-invasion, I was pretty bullish on commodities. I'm still pretty bullish and still long, but just much less certain on where things go from here.
Okay. Can you give me a fundamental reason, Peter? Because I'm looking for technical reasons on why the dollar might be close to an important peak. What would be the fundamental argument for it? Could it be something, so esoteric as the world seeing how we use the SWIFT system as a weapon? We weaponize the banking system. Or could it be that the Saudis will accept payments other than U.S. dollar for their oil? Interest rate differentials. If you could make a bear case for a dollar, and everyone's bullish a dollar again, what would it be?
Well, let's separate the short term versus the long term. The long term is certainly weaponizing the dollar and literally confiscating central bank reserves that are held in dollars. That is certainly going to be a long-term negative as central banks diversify away from the dollar and likely own a lot more gold. I think in the short term, I think we have to differentiate the dollar against other currencies. Obviously, it's been weak against the euro because of the war. It's been, the pound has sort of hung in because people are realizing that the Bank of England is more ahead of the Fed in terms of raising interest rates. The commodity currencies have traded okay. The Aussie and the Canadian have been chopping around.
Till last week, they were the star because everyone was moving to, right?
Right. So like it's not as easy to say the dollar should be up or should be down. It's been more idiosyncratic. And with respect to the yen, if you look back over the past year plus, the yen has actually been trading more with the price of oil because Japan is so energy dependent on imports that as oil prices have gone up, the yen has weakened.
So is there also a correlation with yen with interest rates as well as oil? Because a 10-year, to some extent, mimicked it. Not as strong of a rally recently, but do you think they're tied?
I mean, that's a factor.
But you think oil is more of a factor?
Well, overlay crude in the yen over the past year, and there's a pretty tight correlation. Now, no doubt that the Bank of Japan is going to be the last central bank to tighten monetary policy. So no doubt that will be a factor. And plus, they still have yield curve control. So that is certainly a headwind for the yen. But that they're hurting a lot by this rise in energy prices. Again, since they turned off a lot of their nuclear plants after Fukushima, have only turned back on only a few of them. And they're importing a lot of these high expensive, both crude and refined products.
So you talk about could uranium perform while crude, if crude came off? It looks, here's the royalty trust here.
Well, uranium has had a nice run. I mean, it's now north of 50 per pound.
Yeah.
So it's had a nice move, but even for many, $50 is still below the rate of production. And I still think that there's that supply demand imbalance has been building for so many years that there's still, I think, a lot of upside there as well.
I wanted to ask you about the banks, Peter, because, we had this recent move up in yields, right? And it provided only a lift back to old support, new resistance here. Do you think there's some contagion? And could they be signaling that yields might be peaking short term? What's the problem with U.S. banks? I thought they were so much stronger after everything they went through after 2008. Do you think?
Well, balance sheet wise, yes, but look earnings wise, the housing market is definitely seen its best days in this cycle. That was a big lending driver of theirs, and if the U.S. economy is now going to slow and with the risk growing of a recession, well, you have to start questioning credit quality. That's not a good environment for the banks. So banks are going to certainly trade off more than just where interest rates go. It's also the direction of the economy. And also, last thing is capital markets. If all of a sudden capital markets start to run into trouble and M&A slows down and issuance slows down and so on, at least the big money center banks, slow down in that business would not be good either.
So there's my picture in S&Ps. What are you thinking? Could we have perhaps a sell the rumor by the fact on a 0.5 point interest rate increase?
Well, they're only going to hike 25.
25.
Powell said that.
That's right. Peter would do it, but Jay won't. Okay.
He's only going to raise 25. Now, again, the bond market's already priced in a bunch of rate hikes, so it'll be a non-event. On Wednesday because we've already priced it in. But keep in mind, once the Fed starts shrinking the balance sheet at the same time they continue to hike interest rates, that form of double tightening is what went on in 2018, and we know how 2018 ended. Yeah,
with a rant from Kramer.
Yeah, this time is different, of course, because we have a much higher level of inflation. So
I wanted to ask you about
the flexibility to just stop.
So you were around in where were you in the 70s during gas lines? Were you in the business?
I was watching Bugs Bunny and the Flintstones.
Oh, see, when life was good. Okay. So I know you're a historian, market historian in many ways, Peter. People using analogs to 1970. And I was around and I remember I was in the business for the Volcker tightening. And I remember one of the last groups to come down were the grains. And it took, 18% rates. I don't think we've ever been in a position where we've had, shortages of everything. And how can rates ameliorate food shortages?
Well, when it comes to food and energy that are obviously very inelastic, it's hard to. But
Yeah.
with respect to, I mean, what's the biggest problem with inflation? It's housing. That's the biggest cost of in one's life, and we've made living under a roof very unaffordable for many people.
Okay. So they could have
So
a success if they shave 20% off peak values or something
if they
like that.
reduce the cost of renting and owning a home, that would go a long way in relieving one's overall cost of living. I mean, as a percent of one's income, we spend less on energy and food than we did in the 1970s. And for those
Interesting.
listeners that weren't alive in the 70s, the Flintstones and Bugs Bunny were cartoons.
Yeah. I really was a fan. Well, I always thought every time Fred went to get some ribs, those big ribs, Peter, it would tip his car over. Can you imagine what he was paying for auto insurance? And
Yeah.
his feet. Can you imagine, stopping the car with your feet, seeing podiatrists all the time? So, back to the new age here. What do you think, Peter? I'm looking at this gold silver ratio chart. It's moving sideways, and you're looking for silver to outperform down the road, but could that be interrupted by a recession because silver is also an industrial and people flock more to gold?
Yeah, I mean, that could be an influence. But I think people are learning about the scarcity of a lot of
Yeah.
these industrial metals, and that, yeah, the demand side it will get impacted. But I think this just gets people to appreciate how difficult it is to get this stuff out of the ground, and that you can't just snap your finger and pull it out so quickly. And silver, at least in electronics products,
Yeah.
solar is a very important input in raw material with a very bright demand side backdrop.
Can you come up with any kind of bullish argument for owning stocks here, Peter?
Not in the
Like,
aggregate,
yeah.
but certain stocks like energy stocks, as I mentioned,
Okay.
gold miners.
Okay.
I still like Asian markets, and I'd be buying this pullback. So it depends, I guess, is the answer. Uh, in terms of the big cap tech stocks and the overvalued parts of the market, even with this decline, I would still be avoiding them.
What about the implications of what happened with the nickel market at the LME? And I've seen them try and stop market advances by raising margins and having liquidation only. I can't remember a time where trades were canceled. Can you?
No, that's it, and that they halted trading for days. It's
Yeah.
supposed to be a market that remains open regardless of price, and you let people trade. So I think it was a big mistake on their part.
Yeah.
I understand the uniqueness of this particular situation, but you got to let people trade, and you got to let people interact with others on the buy side and the sell side, and not just halt it.
Do you think that there's also problems with? I hear a lot of these funds are getting major outflows. That they and Russia. Do you have any feeling on Russia being able to make an interest payment, and what would happen with a Russian default under these circumstances?
Well, I think they want to make these the interest payments. I just don't know how logistically they will get the money to the bondholders. I don't know how that will be handled. I don't know whether if it's blocked right now, whether maybe that money is put into some sort of escrow that when the sanctions come off, the money is released. I don't know how that will play itself out logistically, but I do think they at least want to pay back the interest on these on the bond of the bonds that bondholders hold.
Have you ever, do you remember a period where there's been so many unprecedented things happening? This is, to me, one of the, I've seen a lot of different cycles, and this is something that feels different than what I've been through before. Does it feel that way to you?
Well, it's different in that we have high inflation for the first time in 40 years, and we still have bonds in Europe and Japan that are yielding less than zero. So it is very much bizarro land.
And the geo.
And well, you throw in the geo, of course, yes. I mean,
Yeah.
it's a scare geo, but we not to this extent, but geopolitics is typically a fleeting thing in terms of its influence.
Right.
Problem now is that it comes on top of what's already a stressed situation with supply chains and commodity prices that the timing of it was definitely it helped to exaggerate the stresses.
And
not that timing is ever good for something.
Is this really where the biggest bubble is, and is it popped? All the
biggest
financial
bubble,
engineering, huh?
Yeah, I mean, the biggest bubble was global interest rates.
Okay.
When we had a peak of, I think, 16 trillion or 17 trillion of negative yielding bonds at the peak. A negative yielding bond is the epitome of a bubble because you've turned an asset into a liability, and it's the ultimate hot potato as a result. And it's clear that inflation has popped that bubble.
And wasn't this corporate America's margin account where they borrowed money to buy back shares and pay dividends? And
yeah, I mean,
now they're paying a higher margin rate, huh?
Yeah, everything fed off that for sure.
Yeah,
it inflated everything, and now we're going to see we have inflation at the consumer level, and we're now seeing deflation on the asset price side.
Interesting environment. And thanks for the clarity this morning, Peter. Really great to talk to you. And, I hear the conviction in your voice. So it's good to be right. And you know what? I predict this, that people aren't asking you as much these days. Why would you own gold over Bitcoin?
Well, this whole
right?
This whole idea that sometimes that Bitcoin was going to replace gold was such nonsense that I've always said, well, it can complement it, but something that's 13 years old is not replacing something that's 5,000 years old. I don't think people can grasp how long 5,000 years is. And if you made it through 5,000 years, you've made it through a lot.
Yeah. What do you know at 13? Although at my bar mitzvah, I said, today I am a man. And I was wrong about that too. Yeah. So, Peter, great to talk to you, my trading warrior brother. I always pay attention to you when I catch you on CNBC. Everyone follow Peter. You really want clarity about what's happening across the board. I could ask him anything and gives clear, concise answers. Visit him, follow him at Boockvar on Twitter. Go to his website. He has some free things for you to keep in touch with. And have a great spring trading season, Peter.
Thanks, Dale. You as well. Stay out of trouble.
Right. I will, buddy.
All right.
All right, everyone.
Bye-bye.
That's a wrap for today. You could join the team in 19 minutes for the morning edge. People are thanking you, Peter. So that's a wrap. Don't just count your oil barrels, count your blessings. See everyone tomorrow. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.